Year to date, China's hard data remains quite resilient. We expect China's GDP growth to stay above 5% in the second quarter. For the first half of 2025, the Chinese economy is likely to grow by about 5.3%, above the government target. The stronger than expected performance in the first half can be attributed to three main drivers, including first, support from the front-loading activities such as the front-loading of exports and fiscal policies. Second, the high-tech manufacturing is still doing well, and third, policy support from the consumer trading program remains effective. Despite the strong data, headwinds are gathering. First, the uncertainty from the US-China trade tension, despite the temporary truce, remain elevated. Second, the sentiment turned sour again following the intensification of the new wave of 8-point regulations aiming at cutting the government wastage and corruption. Third, the recovery of the property market stalled again due to the still weak income growth and income expectations, as well as the limited wealth effect. Fourth, China's efforts to reflate its economy hit a bottleneck. China's monetary policy remains accommodative. Nevertheless, in China's current context, the monetary easing led to the increase of the production capacity without boosting demand effectively, thereby exacerbating supply-demand imbalances and making the inflation harder to revive. The key to restoring price momentum lies in expanding effective demand, resolving bottlenecks in the real economy, and improving supply-demand circulation. So this requires deepened structural reforms supported by coordinated fiscal, monetary, industrial, employment, and social security policies. The property market is set to play a central role in efforts to boost domestic demand in 2025. As China transitions towards a new real estate development model, policymakers prioritize measures to prevent developer debt defaults, ensuring financial stability within the sector. In addition, we expect PBoC to lower its benchmark interest rate by another 20 basis points this year, although the room for more aggressive rate cuts may be limited given the bottleneck faced by the economy. Beyond conventional fiscal and monetary policy supports, we believe China retains ample policy tools to stabilize the growth. Among them, new type urbanization is likely to emerge as a key strategic focus in the coming years. So this initiative seeks to address hukou-related barriers faced by the migrant workers, enabling them to purchase homes and access public services in the urban areas. If effectively implemented, these reforms could generate a threefold benefit: enhancing social equity, unlocking housing demand by absorbing the excessive inventory, and stimulating consumption as migrant workers integrated more fully into the urban life. That said, given the still uncertain trade outlook and sluggish recovery in the property market, so we maintain our full-year GDP forecast at 4.6%, with the fiscal and the monetary policy easing likely to cap the further downside risk.